Hey, today is Saturday, June 1st, 2019. Taking a look at the S&P 500 as we finish out May and we're getting ready to trade the first week of June next week and finishing out our quarter two for 2019 and getting to about our halfway back point for the year already. Hard to believe it's already that time. Anyway, here we're going to start off by looking at the monthly view of the S&P 500, which I hardly ever bring up because I figure nobody cares. But there's been some interesting activity going on lately, and it's really coming to mind how important it is to occasionally look at these monthly views, maybe more than occasionally as we get into as this sell-off becomes a little bit more severe on the S&P 500. So here's our monthly view. Here is our 10-month simple moving average, and you can see going back all the way to the year 2015, we have had a pretty good successful close above the 10-month simple moving average, going all the way back to around March of 2015. You can see it always held above and closed above, and even as we got into 2018 and the big sell-off from the all-time high that we had hit at the end of January 2019. You can see we even though we traded down and threw a pin down through the 10-month simple moving average, we came back and closed well above it. And all throughout the course of 2018, we kept doing so until we got to October of 2018. And then finally, we blew it. We closed down below it. We made a little head fake close back above it in November, but we rolled over completely in December. And in December, after that first warning shot was fired where we closed below the 10-month simple moving average, we broke it again in December. Then we closed down and broke down below the 20-day and closed below that. Our low for the month of December and for the year 2018 was a back test of the 50-month simple moving average, and circling all the way back here to 2015. That was the last time we had come close to testing the 50-month simple moving average. So this was probably the turning point. You know, long-term fund managers might have been looking at this and saying, okay, let's get out there and buy, because this is it. This is as good as it's going to get. This is, 3 years of progress taken away here, going all the way back to the beginning of 2015. So this flash forward, closing out the month of May, and what did we do? We closed down below that 10-month simple moving average once again. So if that is a warning shot that we are going to go down and eventually test our 50-month simple moving average again before everything is said and done, then that kind of makes sense how we could possibly get back here and test the 2019 low at some point in time this year. When we look a little closer at this monthly candle, we see that it's almost a perfect doubling down on the break of the previous month's candle. As we got to the end of the day on Thursday of this week, we were trading all the way up into the 2790s, and we almost had a fighting chance to come in on Friday and maybe trade up above 2850, which is what we would have needed to do in order to not have a bearish engulfing pattern pull through on the S&P 500 monthly chart. But then we got that news after hours on the Mexico tariffs, and we had a news-driven drop of 30 points in the futures Thursday night coming into Friday. So we came in Friday and we just pushed it all the way down, and we closed all the way down here. And you can see almost a perfect doubling down of the break of that April candle. If we were to take this entire month's candle and double it down one more time, that would get us about down to here. It could happen next month, or it could be something that happens over the course of time, but that would make sense that we, and it's something, a pattern that you could watch for, that once we get low enough to break, that would be back testing the low for 2019, and lo and behold, here would be our 50-month simple moving average rising up, maybe by about, at the angle it's trading right now, I would guesstimate that around September of where we opened for 2019 right here, and that moving average, 50-month simple moving average, double down this May candle, test this January low, and take off from there. So that's just a thought. That's just one way of looking at it from a longer term standpoint. Okay, let's talk about what's happening on our daily roadmap chart. right in front of us. I looked at this bullish cross right here that was happening on May 21st, and thinking that this was going to be a golden cross similar to the 50 and 200-day simple moving average golden cross that happened on April 1st, which resulted in a huge gap up open for us to start Q2. But instead, what was really happening underneath the surface was this. See, the 200-day simple moving average was rolling over. It was beginning to descend. And just because the 100-day crossed up through it, it needed for the 200-day simple moving average to continue rising along with it. In order, this 200-day simple moving average has been rolling over. When you look up above at what's been happening, look at this huge gap down that we got literally the day after the S&P 500 began to decline in value from where it was at the day before. There was your huge gap down open on the 23rd. Okay, and then we tried trading up into that gap a little bit. We've failed every time we've tried to move to the 10-day simple moving average. So selling into the 10-day simple moving average has been a winning bet. And then here we are, another gap down that is associated with the loss of the 100-day simple moving average. On Wednesday and Thursday of this week, we tried, buying the 200-day and then tried taking out the 100-day, but instead, we failed that. On Thursday, once again, they held the 200-day, but they took a look above the 100-day and failed. And then on Friday, we had yet another huge gap down. Now, this is a news-driven situation. This leaves a scene of the crime to revisit, an SOC, scene of the crime. This will get revisited. This wasn't supposed to play this way, and so this will always get corrected because it was news-driven. I can't remember whether this gap was really news-driven. I just got finished saying that I think it was driven by the technicals of this, but I'm sure there was some news involved with it as well. Eventually, we do need to trade back and fill this gap. This would be all the way up at 28.56, and that brings us back home again to the open area of that April candle, which we doubled down the loss of already at this point. So there are some gaps to fill. They would require taking back some simple moving averages, but that could be part of the wild swings that we see go on as we get towards the ES contract expiration, which is coming up. In 2 weeks, it will roll over, and in 3 weeks, it will expire. And we always see some wild swings in the market involving that. Anyway, here is the S&P 500 from Friday, just on an intraday view, 5-minute view. Here's our big gap down open that we had on on Friday morning. We traded down to our low for the day. Within the first 30 minutes, we traded up to our high for the day, looking up into this gap that we had made, into the European closing bell, and then from the rest of the day, we never really could recover. And finally, in the final 30 minutes of the session, we made a tiny little bit lower low than we had made earlier in the day, but we could not break 27.50. And that is obviously because there was, there was a bet on what somebody was controlling from underneath involving the end of month options expiration. There was, no breaking down any lower to satisfy and pay anybody who had puts expiring on Friday below the 27.50 level. But at the same time, if people were rolling out of these 27.50s and rolling into puts down below 27.50 that are out further in expiration, it behooves them to hold price up so that they can just keep rolling and rolling and rolling and getting out to that further expiration. And then we come in next week and boom, maybe we trade on down below there. And up 775 strike is a very highly populated strike as well, and that was being left in the dust. Couldn't trade above that. Maybe there were some short bets against it, or once again, maybe people were keeping price down in order to roll into calls that are up above there, and keeping price trapped in a small space in order to roll their bets forward. Okay, so that's what was going on there. Here is a huge factor and a huge leading indicator known as oil, light sweet crude. Okay. Here is the low that it made 1 day ahead of the S&P 500 on December 24th. Here is the 2019 high that it made 1 week ahead of the S&P 500 on April 23rd. And here it is as of Friday, breaking down below the halfway point between those two levels. If the S&P 500 were to do the same, we will trade all the way down to 2650 at some point. And if we are lagging behind oil by a week, if we're still matching this time frame from up here at the high, then that means as we get into next Friday, when those tariffs are going to be put on, if Mexico doesn't start proper negotiations with the Trump administration or whatever, then maybe that, along with the fact that I think Theresa May resigns and leaves office, next Friday as well, maybe something with Brexit will be going on, whatever. If we are operating a week behind oil, then that gives you some sort of time marker. And I'm telling you that it will follow whatever oil is doing. And right now, oil has shown that it's broken its halfway back point between the 2018 low and the 2019 high. And it even looks like it's maybe on its way to testing where it launched off of a low point in February and late January. So if that translates to the S&P 500, that means 2650, which is our halfway back on the S&P 500 from the 2018 low to the 2019 high. And of course, that's where we were trading back in late January and actually on just in late January. In February 11th, when oil launched its low, we were already our launch up higher. Anyway, so that's what's going on. And on the way down to 2650, we've got one gap to fill next at 2743. We have another gap to fill at 2709.80. And in between those 2 points is this March low that we hit at 2722 and change. Okay. The deal with the March low was that it conspired around the rollover date for the ES contract. It was early. This was on March 8th, but it was early in March because March 1st was on a Friday. For this contract, we have the first Friday in June isn't until June 7th. So everything's pushed out a week later than we saw in March. So in March, this low contract expiration expired up into a rally. Here we have a huge swing coming down, and in 2 more weeks, we will get into that rollover period for the ES contract. Maybe that is when we are going to be down here, down at our lows, and then we will be up on an upswing, heading back towards the 200-day simple moving average as we get into June OpX in the 3rd week. So those are just some thoughts on where we're going and on timing. And as far as what's going to happen as we get right into the day on Monday, we should be looking at the 200-day simple moving average and the 100-day simple moving average. If we come in and we are still holding above 2750, but still trapped below 2775, it's because we're having an inside day and there is still some bets being set and still some rolling into options that is going on. Okay, the halfway back point for Friday is about 2760. If we can come in and trade up above 2760, we look towards taking out Friday's high and going towards that 200-day simple moving average. If we come in and we cannot make it above 2760, then we're going to be coming back down and trying to test 2750. And if 2750 breaks, then we get on the road to filling those gaps and taking care of those levels that I mentioned here. Back from, which one of my charts here? Back from here. So we would go down and we'll look to maybe fill this gap. And if we had lower, even still, we have yet another gap all the way down here at the low 2700s. But at the same time, we have this March low that we might test and bounce at around 2725 to 2722. And that rhymes, again, with an important strike on options. Options are always the highest populated at the strikes that end in 00, 25, 50, and 75. And that's because those are where, and people that run money and just use options on the S&P 500 to hedge their portfolios with will concentrate on those those big round number strikes, and then they will use the expirations in between during the week on Monday and Wednesday, and then those inter-month, Friday expirations. We'll use those, and that's how we get trapped into days like on Friday between two key option strikes, such as 27.50 on the downside and 27.75 on the upside. Okay, I hope that this video, gave you some ideas going into next week, and that, if we're going to be following oil, I think we're going to eventually make our way down here to 26.50. We have the curling over 200-day simple moving average. We need to watch that and see if price can get back above that and trade on through the scene of the crime and take care of some of these gaps that we've left up above. Maybe not get a bounce until we get down here towards the March low. But I do think lower, I think, will happen. Good luck and good trading.